You've probably heard the statistic before. About 90% of traders fail. Many people assume this happens because trading is extremely difficult. Others think traders fail because they are reckless or too emotional. But the real reason is often much simpler. Most traders fail because they were taught the wrong things first. If you have ever taken a trading course, this experience may feel familiar. At the beginning, everything seems clear. The course shows patterns, indicators, and trading setups. The charts look simple and the trades look obvious. But after a few months, something begins to change. Your account goes up, then down, then sideways. A setup works one day but fails the next. Confidence slowly fades and excitement turns into stress. Eventually, many traders begin asking the same painful question. Maybe trading just isn't for me. But in many cases, the problem is not the trader. The problem is how trading education is structured. There are several reasons why structure can quietly push traders into that 90% group. Once you see them clearly, the statistic becomes much easier to understand. The first reason many traders fall into the 90% is an obsession with setups. Many trading courses begin by teaching patterns like flags, breakouts, boxes, and other formations. The message is simple. When you see the pattern, take the trade. But patterns do not make the markets move. Patterns appear after price has already moved, as buyers and sellers interact with the market. Without understanding the structure and reason behind the move, traders often enter positions that look perfect but behave very differently than expected. Chart whisperers approach the market differently. Before considering an entry, we ask some very important questions. What is the market doing right now? Is price trending or rotating inside a range? Is participation increasing? If the structure is not in agreement with the move, the setup means very little. This is one of the first ways traders eventually fall into the 90% group. The second reason many traders struggle is treating indicators as if they are buying or selling signals. Many traders are taught rules such as buying when RSI is oversold, buying when MACD crosses, or buying when price touches VWAP. At first, this sounds logical, but indicators do not predict what is going to happen next. They describe what has already happened. When traders treat indicators like signals, they often enter trades late and chase momentum that has already started slowing down. Chart whisperers use indicators differently. Indicators are guides, not triggers. VWAP, for example, is not a signal to buy. It simply shows a location where participation may appear. The real question is whether or not the price is lining up with that location. Are buyers stepping in? Is volume increasing? Are candles showing momentum? Indicators tell you the story of the market, but do not create the story. The third reason many traders struggle is misunderstanding capital exposure. Many courses discuss protecting capital near the end of the program. First, traders learn setups, then strategies. Only later do they hear about protecting their account. By that point, many traders have developed their habits and are already emotionally attached to the setups they learned earlier. Chart whisperers flip it and reverse this order. Capital exposure comes first. Before a trade even exists, we define where the trade idea might show itself to be wrong, how much capital exposure is acceptable, and what position size allows us to safely enter the trade. If the answers to those questions are not clear, there is no trade to be made yet. This simple habit protects your cash and prevents many emotional decisions. The fourth reason traders fall into the 90% group is misunderstanding emotional control. Many courses say things like, be patient, stay disciplined, and control your emotions. But they rarely explain how to do that. The truth is, emotional control rarely comes from sheer willpower. Emotional control usually comes from position size. When traders expose too much capital, the brain goes into survival mode. Then, fear sets in and decisions become hurried and rushed. Chart whisperers understand that capital exposure influences their emotions. When we keep position size reasonable, the mind stays calm. And when the mind stays calm, we are better able to make disciplined decisions. The fifth reason many traders struggle is overcomplication. Some trading courses fill charts with too many indicators, signals, and complex terms. At first, this looks impressive. But when traders face a real market, something different happens. They panic and freeze. One indicator suggests buying while another suggests selling. The trader hesitates and the trade opportunity is gone. Chart whisperers focus on a small number of things: price structure, volume participation, momentum shown by candles, and price location around VWAP. Simple information often reveals the clearest behavior and makes the chart easier to understand. The sixth reason traders fall into the 90% group is learning strategies before understanding how markets behave. Many courses explain how to trade breakouts or reversals, but they rarely explain why the markets are moving that way. Charts are not just lines moving across a screen. They show how buying and selling activity moves the price. Sometimes institutions are building positions. Sometimes emotional traders are chasing momentum. When traders begin recognizing these behaviors, the market becomes easier to interpret. Instead of memorizing patterns, they begin reading participation and momentum. The seventh reason many traders quietly join the 90% is unrealistic expectations. Many trading courses suggest trading quickly leads to wealth, luxury, and an easy lifestyle. That message attracts people who are tired of working hard and feeling stuck. But when early losses appear, confidence collapses and traders begin believing the problem is them. Chart whisperers take a different approach. Trading is not a shortcut, it is a skill. For many people, the real goal is not luxury. The real goal is greater control over their future, less financial pressure, and more freedom with their time. When you understand these 7 weaknesses, it becomes clear as to why the 90% statistic exists. Many trading courses focus on one question: where should I enter? Chart whisperers focus on a different question: should I even participate in this trade at all? That single question can protect thousands of dollars in capital exposure. Experienced traders understand something beginners often miss. Avoiding poor trades often matters more than finding good ones. Trust me, it is better to see and not be in a good trade and wishing you were in it, than being in a bad trade and wishing you were out. If you have ever felt frustrated with trading education, overwhelmed by indicators and strategies, or unsure why the market behaves differently from one day to the next, then you are exactly the type of trader this channel was built for. Chart Whisperer is not about hype or predictions. It is about understanding structure, participation, momentum, and capital exposure so you can make calm and disciplined decisions. Because trading is not about excitement, it is about control. Control of your capital, control of your decisions, and eventually greater control over your future. And if that is the kind of trader you want to become, subscribe to Chart Whisperer. Because the traders who survive in the markets are not the fastest or the boldest. They are the ones who learn to listen to what the chart is quietly saying.